In 2019, there was a company that told the world it was going to change how humanity worked, lived, and even existed. It wasn't a software giant. It wasn't a biotech lab. It was, at its core, a company that rented office space. But this company didn't see itself that way. It called itself a tech platform, a community, a revolution. Investors handed it a valuation of $47 billion. SoftBank poured in money like it was buying the future itself. And then, in a matter of weeks, the entire dream collapsed. Not slowly, not quietly, spectacularly. The IPO was pulled. The valuation cratered by tens of billions. The founder was pushed out, and the company that was supposed to define the future of work suddenly looked like one of the most expensive misunderstandings in modern business history. So how does a company go from being worth $47 billion to being like a cautionary tale told in business schools? How did sophisticated investors, top-tier banks, and an entire generation of founders all fall for the same story? The answer isn't just about hype. It's about the dangerous gap between the narrative a company sells and the economics that actually run underneath it. And that's what we're going to unpack today. To understand how WeWork became a $47 billion mirage, you first have to understand why so many people genuinely believed in it. Because this wasn't a scam in the traditional sense. There was a real product, real customers, and a real cultural moment that WeWork rode perfectly. Think about the world in the early to mid-2010s. Startups were exploding everywhere. Freelancers were no longer fringe workers. Remote work was becoming a buzzword. Young professionals didn't want to spend their 20s trapped in beige cubicles inside corporate towers with fluorescent lighting and stale coffee. They wanted something that felt alive. And WeWork delivered exactly that. You'd walk into a WeWork space and it didn't feel like an office. It felt like a hotel lobby that happened to have desks. There was craft beer on tap. There were neon signs with motivational quotes. There were yoga classes, networking events, and curated communities of entrepreneurs. WeWork wasn't selling square footage. It was selling identity. It was selling the idea that work could be cool, that being a young professional in a big city could feel like belonging to something. And the branding pushed this narrative even harder. WeWork didn't position itself as a real estate company. It positioned itself as a technology company, a lifestyle brand, a movement, and at the center of all of it stood Adam Neumann, a 6'5" Israeli entrepreneur with long hair, a bigger-than-life personality, and a gift for storytelling that bordered on prophetic. He didn't talk about leases and occupancy rates. He talked about elevating the world's consciousness, and in a market hungry for the next big disruptor, that kind of vision was exactly what people wanted to hear. Now, once you have a story that powerful, the next move is obvious. You scale it. And WeWork scaled like almost no company in real estate history. New cities, new countries, new buildings every month, massive lease commitments, beautiful renovations. By the late 2010s, WeWork was one of the largest private office tenants in cities like New York and London. And in the era of cheap money and unicorn fever, this kind of growth was treated as proof of genius. Investors weren't asking whether each location made money. They were asking how fast the next 10 could open. Growth was the story, and the story was the asset. But here's the thing that started to quietly become a problem. Every new location wasn't just revenue. It was also enormous expense. There were lease obligations to landlords, often stretching 10 or 15 years. There were build-out costs, sometimes millions of dollars per location. Just to make the space look like a WeWork, there was staff, marketing, free coffee, free beer, events, design teams. And WeWork wrapped all of this in startup language to make it sound like something it wasn't. They talked about network effects as if adding another office somehow made the previous offices more valuable. They talked about platforms, total addressable markets, technology stacks. The vocabulary was Silicon Valley. The reality was concrete and drywall. And here's the uncomfortable truth that growth tends to hide. Growth doesn't fix a broken model. If your unit economics are weak, scaling just means you're losing money in more places at once. WeWork's revenue chart looked like a rocket ship, but underneath that rocket was a fuel tank that was burning faster than anyone wanted to admit. So let's talk about what was actually happening underneath the surface, because this is the heart of the entire story. WeWork's business model, stripped of all the buzzwords, was almost embarrassingly simple. They signed long-term leases with building owners. Then they took those spaces, divided them up, designed them beautifully, and rented them out to individuals and companies on much shorter terms. Sometimes month to month. Sometimes for a single desk. Sometimes for a small team that might leave whenever they wanted. When the economy was booming and offices were full, this looked like magic. WeWork would lock in a long-term rate from a landlord, then charge a premium for flexibility, design, and community on the customer side. The spread between those two numbers was supposed to be the business. And in good times, with high occupancy, that spread could generate real cash flow. But notice what's hiding in that structure: the risk. WeWork's customers had all the flexibility. If a startup got hit by a downturn and needed to cut costs, they could leave a WeWork office in 30 days. If a freelancer's income dropped, they could cancel their membership. The customers had short-term commitments, but WeWork itself had long-term commitments to its landlords. 10-year leases, 15-year leases, locked in, non-negotiable. So what happens when demand drops? The customers walk away quickly, but the lease obligations don't move at all. WeWork still owes the rent, still owes the maintenance, still owes the operating costs. The asymmetry isn't a small detail. It's the entire structural risk of the business. And the more WeWork grew, the more this asymmetry compounded. Every new lease was another long-term liability. Every new market was another bet that demand would stay high forever. The customers had a door they could walk out of. WeWork had a door that was bolted shut. And in the language of finance, that's not a tech company. That's a leveraged real estate operation wearing a hoodie. Which brings us to a question that, if you really sit with it, kind of breaks the whole story. If WeWork was really a technology company, why did it carry the risks of a real estate company? Real tech companies, the actual ones, scale with software. Once you've built the product, adding another customer costs almost nothing. The marginal cost is close to zero. That's why companies like Google, Microsoft, and Salesforce can produce such enormous margins. WeWork couldn't do that. To grow, WeWork had to sign another lease, pay another deposit, renovate another building, hire another team, buy more furniture, more plants, more neon signs. Every unit of growth required a new physical investment and a new long-term obligation. That is the exact opposite of how a software business scales. So the real question becomes, why did the market ever value WeWork like a software company in the first place? And the answer takes us directly into the next part of this story. Because the valuation wasn't really about the business. It was about the story. The $47 billion valuation didn't come from a spreadsheet. It came from a pitch. And the pitch was that WeWork was not a real estate company at all. It was the future of work. It was a global community platform. It was a data company that could analyze how people moved through space. It was, in Adam Neumann's words, a company that would eventually expand into housing, education, fitness, banking, and basically every aspect of modern life. There was We Live for residential. We Grow for schools. There was talk of WeBank, of We Sail, of acquiring waves in the ocean. I'm barely exaggerating. And the more expansive the vision became, the easier it was to justify a valuation that had nothing to do with actual cash flow. Because once you're in vision territory, you're no longer constrained by reality. SoftBank, led by Masayoshi Son, became the biggest believer. They poured billions into WeWork at higher and higher valuations, validating the story with every check. And once SoftBank set the price, other investors followed, because nobody wanted to miss the next Uber, the next Amazon, the next category-defining giant. But here's what was actually happening. The more WeWork stretched its narrative, the further it drifted from financial discipline. The company stopped behaving like a business that needed to make money. It started behaving like a vision machine that needed to generate excitement. And there's a key difference between those two things. A business machine is judged by output, a vision machine is judged by belief. As long as belief held, WeWork could keep raising money, keep signing leases, keep losing more every year, and call it progress. The danger of running a vision machine is that the moment belief cracks, there's nothing underneath to catch you. And belief was about to crack because of cracks that had been forming inside the company for years. The deeper investors looked at WeWork, the more they saw a company that wasn't really separable from one man. Adam Neumann wasn't just the CEO. He was the brand, the profit, the energy, and increasingly, the liability. There were stories about wild office parties, tequila shots and board meetings, marijuana on private jets. There were governance structures that gave Neumann extraordinary voting control, far more than any normal CEO would have. There were related party transactions that raised serious eyebrows, like Neumann personally owning buildings that WeWork then leased from him. There was even a moment where the company paid him millions of dollars for the trademark to the word "we" after he tried to rename the entire company. When you're a private startup writing a growth narrative, a lot of these things can be brushed aside. The story is too good, the trajectory is too steep, and nobody wants to be the killjoy who slows it down. But preparing for an IPO is different. Going public means submitting yourself to a level of scrutiny that private companies never face. Public investors don't fall in love with founders. They read footnotes, they ask uncomfortable questions. They want to know how the money actually flows. And in 2019, when WeWork filed its IPO paperwork, the curtain that had been hiding all of this finally got pulled back. What happened next is one of the fastest reputational collapses in modern corporate history. The S-1 filing, the document a company has to publish before going public, was supposed to be WeWork's grand introduction to the public markets. Instead, it became the most damaging document the company had ever produced about itself. Analysts and journalists started reading it carefully, and what they found wasn't a tech company at all. They found enormous losses, getting bigger every year. They found tens of billions of dollars in long-term lease obligations. They found governance structures that concentrated power in one founder to a degree that public markets rarely tolerate. They found language so theatrical it became its own joke. The filing dedicated the company to the energy of we, mentioned community hundreds of times, and barely managed to explain how WeWork would ever actually become profitable. And the more people read, the more obvious the gap became between the story WeWork had been telling for years and the numbers it now had to legally disclose. The valuation collapsed in real time. 47 billion, then 30, then 20, then less than 10. Banks panicked. The IPO was delayed and then pulled entirely. Adam Neumann was forced out, walking away with a controversial exit package, while thousands of employees lost their jobs in the restructuring that followed. And here's the line that I think really captures what happened. The market didn't reject WeWork because it failed to understand the company. The market rejected WeWork because finally, after years of mythology and momentum, it understood the company exactly. A startup can survive a long time on narrative inside private markets, but an IPO forces narrative to meet reality, and reality, when it finally arrives, doesn't negotiate. What was left after the collapse wasn't nothing. WeWork still existed. The offices were still there. People still rented desks. The company eventually went public, BDAO through a SPAC at a fraction of its former valuation, restructured aggressively, replaced its leadership, and kept trying to operate. But the fundamental problem never really went away. The leases were still long. The customers were still flexible. And then the pandemic arrived, and the entire concept of office demand was thrown into chaos. Remote work exploded. Hybrid work became the default. Companies started shrinking their physical footprints, and the co-working model, which had been built on the assumption of ever-rising demand for shared urban office space, found itself in the worst possible environment. WeWork eventually filed for bankruptcy in 2023, the final confirmation of what the IPO disaster had hinted at 4 years earlier. The product wasn't fake. People genuinely wanted flexible, well-designed workspaces. The demand was real. But real demand doesn't justify a $47 billion valuation. And here's a lesson that gets lost in a lot of startup coverage. A useful product can still be a terrible investment if the financial model around it is structurally broken. WeWork made something people liked, but liking something and being willing to pay enough for it to cover 10-year lease obligations across dozens of cities are two very different things. So what's the bigger lesson here? The one that connects WeWork to every other failed unicorn we've covered or will cover in this series? WeWork didn't fail because it lacked vision. It failed because it had too much of it. Vision became the thing the company hid behind whenever the harder questions came up. Are the unit economics actually working? Where does the real risk sit on the balance sheet? Does growth make this model healthier or more dangerous? Is the founder serving the company, or is the company serving the founder? These are the questions that tend to get drowned out when a story is exciting enough, and almost every failed unicorn shares this same pattern. Theranos sold a story about revolutionary blood testing while the technology didn't work. FTX sold a story about being the trustworthy face of crypto while running an alleged fraud underneath. Quibi sold a story about reinventing entertainment without ever validating that anyone actually wanted what it was selling. The names change, but the structure repeats. Narrative becomes the most important asset on the balance sheet, until the moment it isn't. And then there's nothing left to support the valuation. WeWork is the textbook case of an era when growth was treated like a religion, and profitability was treated like an inconvenience to be solved later. It's a reminder that markets can be wrong for a very long time, especially when cheap money makes belief cheap too. And when belief finally has to be paid for in cash, the bill comes due all at once. In the end, here's the thing that always stays with me about the WeWork story. The dream wasn't fake. People really did want better workspaces. People really did want to feel less isolated when they worked. People really did want offices that felt human instead of corporate. WeWork tapped into something genuine. The problem wasn't the dream. The problem was that what the company packaged that dream into a narrative far bigger than what the underlying economics could ever support. They sold community. They sold technology. They sold revolution. But underneath all of that, the business was still mostly long leases on one side and short-term tenants on the other. And when the cheap money disappeared, when the founder charisma faded, when the market finally decided to read the footnotes, those leases were still sitting there. Quietly, patiently, doing what leases do, demanding to be paid. The most dangerous thing in business is rarely a bad idea. The most dangerous thing is a good idea priced as if it could never possibly fail. If this kind of breakdown is what you came here for, this is just the beginning of the series. I want to know which failed unicorn you want me to take apart next. Drop it in the comments. Theranos, FTX, Quibi, OIO, Better.com, Nicola, all of these are on the list, and I'm going to get to them. This series isn't just about watching companies collapse. It's about understanding why so many smart people believed in them right up until the end, because that's where the real lessons live. If you found this useful, hit like, subscribe, and stick around for the next breakdown of a billion-dollar dream that didn't survive contact with reality. I'll see you in the next one.